Good morning, ladies and gentlemen, and welcome to the Downing Strategic Microcap Investment Trust PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Fund Manager Judith Mackenzie. Good morning.
Good morning. Thank you. So we are on the road. We're seeing companies. It's great to be out seeing companies again, and also marketing, which is why we're sitting quite close together. We wouldn't normally be this close. Not that there's anything wrong with that. But so what is Downing Strategic Microcap Investment Trust? So we have a portfolio of handpicked UK microcap companies, 12 to 18 positions, under 150 million market cap at the time of investment. And what we're doing is we're taking strategic stakes in these businesses. We're buying between 3 and 25% of the underlying equity, and we're working with those businesses to find catalysts to unlock intrinsic value over a 5 to 7 year period. And we're about 5 years into the journey with this portfolio, so you've got a degree of maturity in this portfolio now that we'll come on and talk about. We're going to talk about catalysts a lot, and we're not going to apologise for that because it really is absolutely key to find those strategic drivers that we can use to help companies realise that value creation. And why now? Well, as I said, it's a mature portfolio, 5 years into the journey, so it's a kind of de-risked entry point. And we're also sitting at quite a discount to our net asset value. There's also a 2024 redemption option, at 50% of NAV, which is quite an attractive thing to have in front of you. So quite a busy slide, but the main points here are that we are 30 million market cap and we are listed on the main market. Very much a high conviction, bottom up type strategy with active engagement across these 12 to 18 companies. In fact, we've got 16 at the moment. So very much looking at that under 150 million market cap range, which is where we see there's a real opportunity to hunt value, especially at the moment. And we'll talk again about those strategic catalysts. And that really helps us close the gap between the current value and the intrinsic value through these big stakes that we're taking. A little bit about ourselves. So Downing LLP has been around since 1986, about 1.8 billion under management and about $500 million in publicly listed assets. And we specialise in public equity, energy and infrastructure and property development. But our side of the business is obviously the public equity side. And I've been investing in UK small cap companies for 24, 25 years now. That's all I've really ever done. I cut my teeth at Aberdeen Asset, investing in both private and public companies. And really that's what gave me the tools in the toolbox to help me use those strategic mechanisms that we put into these types of companies. Nick, do you want to talk about yourself?
Thanks. Yeah, I'm Nick. I joined Downing in September 2015. And before that I was at BP Investment Management. And before that I was also at Aberdeen. And I joined to help in smaller company mandates over at Downing, with a specific focus on the smallest end of the universe that we invest in, the sub 150 million market caps. And this slide kind of visually explains why we're in this end of the market. So in short, it gives us the most opportunity. So that's the highest count by companies. It gives us the most opportunity at the lowest valuation. So you can see there on the curve that we can pick companies up at much lower, typically much lower valuations than if they were larger market capped. And we can do that because of the inefficiency. So there's less analysts looking at these companies on both the buy side and the sell side. And most of that is due to asset manager consolidation, pushing combining capital and pushing capital further up the market cap curve where the liquidity exists, and also because of things like MiFID II, which took away a lot of the quality and cover of UK smaller companies. So for stock pickers, we think that this is the best part of the market to be investing in, and to the extent that we can own or find unloved and overlooked companies, and we can walk them up that market cap curve, then then we can benefit both off earnings expansion, hopefully, but also multiple expansion and liquidity along that journey. This tells us, explains a bit about how we invest, how we tend to find opportunities. The objective of DSM is obviously to invest in small companies, as Judith said, and we're aiming to find unloved and overlooked businesses which are on low multiples and with low earnings versus where they should be on a more normal basis. So typically what we're looking for is opportunities where there's a few issues, but issues that can be fixed. So they might be fixed, typically by a new management team, most usually a new chairman. And by fixing those, we think that can kind of unlock value. The market can start to look at the fundamentals in a more normal way, and we can get multiple expansion and hopefully earnings expansion along that journey. Typically we know what we're looking for, and that universe at any one time has tended to be fairly small, albeit is significantly larger in the last 6 months, and will most likely get larger again in the next 6 months as more smaller companies have more issues. So it's a fantastic place to be just now, and we've got obviously cash to invest as well. In terms of diligence, I guess in many ways the same as most other managers, but what we do attempt to do that a lot of other managers won't do is to interview suppliers, interview customers, interview other shareholders, and we'll interview the full board of most of our holdings as well. So not just the chairman and not just the management team there. And then the key point, as Judith said, is to identify catalysts and to make sure that we can actually execute on those catalysts. So that's both key diligence point on the way in and also on the holding journey of that position.
Thanks, Nick. So just in terms of the portfolio, so very frankly, we're cheaper than the larger cap companies, got better value and very typically better earnings as well in our little universe of around about 140 odd companies. And that's taking out some of the mining extraction companies within the universe. We invested in 16, can invest in up to 18, average market cap about 65, EV/EBITDA of about 6.9, which is nearly half that of the universe, and median PE of about 12 times, which is about, again, significantly less than the 20 odd times on the universe. So you're buying cheaper, you're buying opportunities that have got catalysts, and you've got strategic mechanisms through the larger shareholdings that we've got in these underlying companies to be able to deliver them. So we're going to talk a bit about, first of all, I suppose, how we look at the portfolio. And we always have a value thesis. Here we can have recovery, SOTP, which is sum of the parts. We can have asset backing, re-rating and growth is quite a common theme here, as is recovery. So those are the kind of baskets that we put these portfolio companies into. This is our top 10. And we're going to talk about a couple of them here, not all of them. So you can get a bit of a flavour as to why we might look at as sum of the parts or a recovery basis. I'm going to talk about Ramsden's, which is about 6.3% of the portfolio. And we talk about some of the strategic mechanisms that we can put in place. Now, those can be anything from maybe board changes, restructuring, refinancing, merger and acquisition activity, or actually maybe something just as basic as helping with the company's IR. So Ramsden's very well-run business. You might have come across them in the high street. They are a pawnbroker, but they also sell FX, and they're also now one of the largest online retailers of jewellery in the UK. And obviously had a bit of a hard time through COVID, but very much been a recovery play. And we think quite defensive as well at this point in the market. Net cash in the balance sheet. Pawnbroking, sadly, is probably only one of the few safe places you can go for short-term lending if you're in the high street. And actually, there's the nice hedge as well with the FX side of the business. People going back on holiday again, we've really seen a recovery in that. So in this business, there was not really too much for us to do. We had a good relationship with the management team, but we felt that they were they were quite shy about talking about themselves. So this is where we went out on the IR side, and we took a camera crew up to Middlesbrough, and we interviewed the management team on site, and we then publicised that video, and it helped to get them on that road, that journey to improving their own IR. We helped them out sometimes with their presentations and just giving them feedback on the way they presented themselves. So very small, but nicely doing something around the edges that got the company noticed. It's probably the lighter touch element of a strategic activity. Do you want to talk about one of the others, Nick?
Sure, I'll talk about Digital Box, a company we added a couple of years ago now. In terms of what Digital Box does, it's a digital-only publisher. They monetize a few titles that they own via ad spend. What we identified at the time was a company we thought had a lot of potential, but was subscale, and they had to make, in our view, a few acquisitions to get to earnings scale, and we didn't think the board was in a particularly good shape to allow that to happen. Management had identified an acquisition that they wanted to do, and we thought that with the board change and combining that with the acquisition, then this was a viable business and a good place to be. We funded that acquisition at about 4p or 4 times EV to EBITDA. And since then, that business has performed exceptionally well. They've got a well-invested back end, well-invested tech stack, so they can buy these underperforming assets, they can plug them in, and they can take the cost out, so they can turn loss-making businesses cash flow positive fairly quickly, and that's exactly what we did. So we bought on 4 times EV to EBITDA. In a normal market, we think that these should be valued on 10 to 12 times, so 2.5 turns of upside there potentially, and also we saw a fairly clear pathway, just using organic cash flow to fund acquisitions to well over 2 million of EBITDA. So we're well down that journey now, and the business has performed exceptionally well, albeit with a few headwinds now on consumer spending.
So why now? As a mature portfolio, we've been doing a lot of work on this portfolio over the last 3 to 5 years. You'll see that the vintages are anything from 2017 through to this year. So what we're trying to do here is build a portfolio where there'll be some breakouts over the course of the next 6 to 12 months. And I think if you look at some of the strategic actions that we completed, you've got board changes, you've got restructuring, you've got strategy changes, you've got simple things like revamping websites, you've got M&A activity, you've got incentive schemes being put in place, strategic partnerships, and just basically sort of refocusing of marketing as well, and IR that we talked about earlier. I'm going to talk about Synectics on this one. So Synectics is a business that's been in, I suppose, the security space, command and control, security systems for anything from a railway station for Deutsche Bahn in Germany, right the way through to a casino in the States. So a really great market presence. And we invested in this because they were switching from selling boxes, bits of kit, into a software solution. And you're now beginning to see that margin coming through. But here, what we felt needed done was a revamp of the board. Some really good people on the board that had helped the company through the years, but there probably needed to be a bit of a change when it came to refreshing. The incentive scheme was really quite key as well. So I won't go into the absolute detail, but if you look at that incentive scheme, you'll see that the targets that the management team have given themselves and we've ratified basically mean that the target price, share price, should be between sort of £2.30 and £3. Share price today is sitting at £1. So we can see you can get 2 to 3 times money out of these types of companies if you put the strategic action into them. Nick, do you want to cover one other?
Sure, I'll talk about Flowtech. Again, one that we added in kind of peak COVID when they were significantly under earning on the back of customers being closed in the kind of second quarter of 2020. We'd known Flowtech for a while, and it had been a business that we'd followed and one that a management team had built up via acquisition. What we didn't like about it at that time was that the acquired businesses were left as kind of siloed businesses, that they hadn't been pushed together, and the synergies hadn't been taken out. And a small bit of mismanagement combined with that led to quite a significant underperformance. There was a change at the board level, a new chairman. There was a change, some of the exec team as well, and they came out with a new plan to halt the M&A and to focus inwardly, to take costs out, push the businesses together, to take SKUs and heads out as well, to make a more efficient business. We thought that was backable, and we bought in on the back of that. So most of those actions have played out, and businesses have come out of COVID and performed well. It's now back to the sales level of kind of where they were in 2019. And the next step is now a bit more investment. So they will invest in the e-commerce opportunity there, which their peers don't have, but which should allow them to capture more wallet share of existing customers. And then there's another piece to allow them to convert more accounting earnings into cash flow, and that is working capital focus. So when we look at this business, we think that they should be on 4 turns plus of stock, and that's kind of what good peers tend to do, and they're lagging significantly there. But if they can execute that, then there's a pathway here to double-digit cash flow margins, and we think that on the back of that, they would earn a much higher multiple as well. So we're kind of well on that journey, and once the market starts to normalize, when supply chains start to normalize post-COVID, then we think that they can execute those efficiencies fairly well.
So hopefully you're getting an idea that we're taking these 12 to 18 companies, we're taking these strategic stakes, and we're putting in these actions alongside good management teams to really help start to realise value. Now, they don't happen overnight, obviously, and very often you find that you might even be doing share price damage in the short term, but it's really when you start getting the breakout of some of these strategic actions ongoing that you get the realisation of that intrinsic value. And the good thing is that this is not market dependent. We're not just betting on the stock market, rebuying these companies. We're looking at both strategic exits when it comes to M&A, so whether that's trade or private equity, but we're also looking, as I said before, at some of the parts and other mechanisms to realise value. It's not driven by a rather volatile stock market, fortunately. So we wanted to try and highlight what the upside was in this portfolio and these top 10. Now, we've taken the consensus target price. I would point out that is not necessarily our target price. It's what our compliance team like, because we can point to somebody else's numbers as opposed to putting our own views in it. But we'll give you a bit of a flavour as to where our views are as well. And there you can see that you've got anything from a consensus target price and where we are just now to the implied upside on those numbers of between sort of anything between 70 and 200%. So quite attractive. I would say that ours are slightly higher than that in certain cases, but not in all cases necessarily. I'm going to talk about Central Media, which is one of our larger positions, and they are, as they say, they're a media company, and they own the title The Lawyer, which really is the predominant publication for the legal market. And they also have a very good marketing services business. Now, these are two parts of the business that don't really sit that naturally together. And therefore, that is why this is one of the sum of the parts arguments. This is a business that's got 16 million of cash, and it's got a plan to generate 23% margins by 2023. So we're nearly there on that pathway. And that means it would have about a 16% free cash flow yield. So it's throwing off cash, it's got net cash in the balance sheet. We've got two assets that sit next door to each other that don't really have any synergies, and there's probably about £3 to £4 million of centralised costs that could be taken out. So I'm probably leading you to the conclusion that at some stage we would think that these assets would sit separately. And here our view is north of £1 at the moment for the valuation of those two well-performing assets. You want to cover off another?
Sure. Yeah, I'll take Enwar down at the bottom of this table here. So again, one of the newest investments that we made just at the beginning of this year. The business is the third largest UK newspaper publisher, and they're on a journey to digitize that business. So that's moving titles online, but also actually digitizing the legacy kind of middle and back end of these old publishing businesses. And by doing that, we think that they can massively expand margins. But we also think that there's a big opportunity to acquire other businesses that the company has almost 50% of its market cap in cash. So a key part of this thesis is that they can find either other underperforming legacy businesses, legacy publishers, or indeed kind of more digital publishers, which they can bolt on into the existing business. It is one of the cheapest companies in the portfolio. It's well under 4 times EV to EBITDA. One of the nice things about this is because it's new, it comes without the kind of legacy cost base and legacy issues that a lot of these publishers do have. So there's no big pension scheme here. There's no big London offices. There's no phone hacking liabilities or anything like that. So it's exceptionally clean, and because of that, most of that EBITDA falls down to the bottom line, and also falls down to cash as well, for the capex light and for the working capital light. So they can build that cash balance, which again they can use to acquire, and they can also use to invest back into content, which is exceptionally important here. But we see, an opportunity here for, again, multiple expansion in a normal market, but also earnings expansion as well. So that 40p consensus, we think is a fair short-term target, but longer term we see a much larger opportunity than that. And just in the last week or so, the company's gone into play. They've announced they're looking to acquire one of their larger peers, which may well play out. It's exceptionally ambitious, but what we suspect could also happen is that they become acquired by said peer. Either way, shareholders we think could do fairly well in those situations.
So I think you'll see here from the vintages that we've got as we've talked through these strategic actions that there is a degree of maturity within the portfolio now. We've got a good number here that are from 2017, where there's been either management change, there's been strategic focus, there's been M&A activity that we've helped implement, sometimes help fund. And then you've got a younger flock coming in that are showing the attributes of being exceptionally cheap, but also having their own levers to pull. And as we go into this phase in the market, we find that this kind of strategy does tend to play out in a way that, as I said before, is not is contrary to maybe the way indexes behave. And you've certainly seen that in the performance of the trust over the last 6 to 12 months. So we managed to rattle through that quite quickly. It's a concentrated portfolio of hand-picked positions, micro-cap companies, 12 to 18 portfolio positions under 150 million market cap. The key here is the strategic drivers that we can put in place. That's the M&A, the change in management, and you can see that right the way through the portfolio here. And you can see that the maturity of that is now beginning to come through. And therefore, we expect those catalysts to be delivering performance over the next 6 to 12 to 18 months. We're not dependent on the market sentiment, fortunately. And this kind of strategy allows business transformation and allows you as an investor to unlock intrinsic value. We're much more comfortable sitting with these 12 to 18 positions in a value part of the market than we would be with maybe a portfolio of 100 companies where you really are going to be dependent on what the market is going to do on a day-to-day basis. These companies are master of their own destiny. And why now? This is a really interesting investment trust that you're getting access to these strategic mechanisms from managers that are used to both private markets and public markets. The portfolio is certainly at an inflection point. you're de-risking your entry point at the moment because you're coming in at a 26% discount thereabouts to NAV, and you've also got the optionality, the 2024 redemption option, which is 50% of net asset value. And that's us concluded the formal part of the presentation, and we will go on to questions.
Judith, Nick, absolutely. If I may just jump back in there and give you a moment, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Judith, Nick, we obviously received a number of pre-submitted questions ahead of today's event, and as you can see in the Q&A tab, we have also received a number of questions during your presentation itself today. So firstly, thank you to everyone on the call for taking the time to submit their questions. And guys, if I could just hand back to you to address those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay, yeah, I'll take the first question. So the first question is on steps being taken to deal with the discount to NAV. We're pushing marketing quite a lot. So the last few weeks we've been out speaking to investors and potential new investors. As you know, the board also do have a buyback policy. So there was a point where they weren't buying back shares, but they are now back in the market, and we will manage the discount accordingly.
Okay, I'll just flick down to the next one. This is a good question. We could be here for quite a long time debating this one, I suspect. There is unquestionably extraordinary value in many smaller companies by any standard. Sadly, the sector is currently toxic and illiquid. What do you see as the catalyst to bring back private and institutional investors to unlock the value in the smaller company sector? And this is something that's probably quite close to my heart, actually. I'm a chair of the Quoted Companies Alliance, and this is something that we focus on quite a lot. But what I would say is, I don't think it's toxic. I think we've got some cracking UK companies that really are the stalwarts of the UK economy, and we probably don't shout about them enough. I think the private investor network is now actually very, very strong and very good, and we've got to be able to, as institutions, we've got to be able to support it. That's events like Mello and supporting this kind of platform. The other thing is we need more buyers than sellers, and it's interesting to see that Richard Penny of Crux is due to launch or has launched a microcap investment trust as well. So I think the more buyers there are, the better. I think some of the questions here are very much focused around that. Well, why bother? Because nobody cares about small cap. The reality is, having been through too many points actually in a cycle like this, where you see that small caps are really just being ignored by the general marketplace, what tends to happen is that they are more ambidextrous, they're capable of these kind of strategic changes, and when the markets do change, suddenly they come back in favour. We're trying to do two things. We're going to take advantage of that when it does happen, but we're not going to wait for it to happen. We're putting those strategic changes in place, and we're going to drive the portfolio to make sure that they're delivering non-index correlated returns. And that includes, one of the questions I think is about whether private equity is coming into this market. And we are certainly seeing that international buyers are finding our companies that are typically on 11 times earnings are much cheaper than their peers across the water, and they're decent quality as well. So that's me trying to answer about three questions in one there. So I'll try and be a bit more focused. Do you want to take the next one?
So we've had a question on which holdings we've been topping up given the market weakness. I'm not sure if we'll comment explicitly on the companies by name, but if you were to look at the list of the top 10 equity positions, and you can see which ones are the cheapest, those are almost certainly the ones that we've been topping up. And alongside that, we've added a new toehold position which we've been building for about a month and a half, or adding to for a month and a half. So there's opportunity out there, and again, as I said at the beginning, we're seeing many more opportunities now than we saw 6 months ago, and certainly over the next 6 months, I suspect there will be even more as small companies have more issues. On the other side of that, we are always taking cash out of positions that we think have become overvalued, or where we see a better opportunity to deploy the cash elsewhere.
I'll take this one. What is the likely need to invest further funds to recover amounts already invested in Real Good Food? I sit on the board at Real Good Food, so there's a limited amount I can say here. However, the public information is that there is a project underway for significant cost reduction and a reshaping of the business, which is certainly going to plan. We don't envisage that we would have to put more money into Real Good Food. If we do, I would suspect it's only the basis of growth capital as opposed to rescue capital. And we've always said, or sorry, again in the public domain, that the target here is to get the business back to a stable footing of between 3 and 4.5 million of EBITDA. And that clearly, along with the asset base, has got a decent value. And here we've got secured loan notes. So there's hardly any bank funding at all. There's no bank funding at all, actually, aside from the secured loan notes that we hold. So we've got quite a few levers to pull with that investment. Let's do this one.
Yeah, so we've got a question on liquidity, and so given the number of holdings that we have, over a 10% stake, how likely is it that we get an exit in the market, or do we have to exit that in whole via some sort of event? Now, I think we've shown with companies like Volex that you can absolutely get an exit and liquidity for partially in the market. So the idea being, if we can buy overlooked companies that other people eventually will want to own, and that can go on that journey up the market cap curve, then we can exit fairly effectively. So Volex, as an example, if we go all the way back, was a 70 million market cap company, and we owned 8% of that business. The market caps has at some points been close to 10x where it started, and we've sold down our position almost 8% down to a little over 2.5%. So there absolutely is liquidity in this market if you pick companies that other people want to own. And then on the other side, as Judith said, we think that with company valuations where they are, and also with sterling where it is, then there's opportunity for wholesale exits as well.
Interesting question. I'm a bit confused with the consensus target price. If there's barely any sell or buy side cover, why use consensus instead of your target price? How do you derive your in-house target price? We're using consensus because we feel it's a independent metrics instead of our own view that you can point to. I think that it would also be good to talk about our target price. However, our compliance departments say very often you're not even allowed to talk about target prices, consensus prices, but the industry is such that we're not really allowed to give too much an opinion. However, you can read our investor letters and you can certainly see where we're getting our consensus values from. And that should allow you to get some direction. I think we've probably talked about a few of them today. How do we arrive at our consensus, our own target prices? It's a combination of valuing the future free cash flows, the net asset value potentially, if there are assets there, and also looking at the potential earnings growth that you can drive from unlocking some of these strategic actions. So you do have to take a bit of a view on your effectiveness of your strategic activity when you're looking at your overall valuation. Is there anything you want to add to that?
No, I don't think so. We have got quite a few questions on kind of company specific points, some of which we answered in this, others which we've not, but asking quite detailed questions about companies, which we actually cover quite a lot of in our investor letters. The last 2 letters will answer quite a few questions on HSP in terms of the German JV there and how we think about that and the unlocking of cash within that business, and also on Fire Angel as well. So, those would be fairly...
and what we will do is we will reply to these questions, because there are quite a few. We'll reply to them offline, and you can then see the reply to those questions, because we could probably spend quite a lot of time. I can talk about the works for 15 minutes, which I probably shouldn't do. I think a couple of sorry, could you please speak on what assets the RGT loan notes are secured against? Well, there's a good amount of acreage and a massive site up in Liverpool. If you Google Renshaw, Crown Street, then you'll see how large it is if you look on Google Maps. So that's an asset in its own right. There's lots of kit there. It's a manufacturing business. So yeah, there are proper hard assets. This is not goodwill that we're secured against. Yeah, quite a few people talking about the size of the trust. You probably already saw in the last couple of days that actually it doesn't take much to move that discount in. So we were sitting at a 24-25% discount. We got a bit of recognition in the Investors Chronicle, and then the discount moved to 14 or 15%. Can't quite remember what it is today. And so therefore, this is why we're getting out marketing. We have changed our broker. We've got Kepler writing on us, and we're really, just like we are with many of our small cap companies, we're trying to get a bit of recognition, because we feel that the valuation of this portfolio and the catalysts that are put in place are so stark that it should and will attract attention, as we saw even in the last few days. So it's a combination of marketing, combination of actually performing, and it's a combination of trying to generate some buyers for the trust to get that discount in, alongside a healthy buyback policy as well.
And we've got a question on basically why we're not fully invested just now, given potentially how easy the market's been. Well, I think over the last 2 weeks, obviously that's a fair point, but over the last 6 months, it's obviously been much more difficult than that. As I said, I think the feeling is that things are going to be much more difficult again over the next 6 months, and there'll be better opportunities than there are now. The other thing is we obviously have to move in, not massive size, but in kind of substantial size that, and we want to own a decent amount of equity in the companies that we're investing in. So that a lot of the time that'll be based on some sort of event, and we kind of keep our cash for opportunities like that. Not saying that we won't attempt to build positions in the market, but when the market's like this, and we think that small caps are going to have, or many small caps will have some funding issues, then that's a better opportunity for us to buy more significant stakes at much larger discounts than we would be able to do in the market.
Okay, I think that's probably us for just now. We will answer the more specific company ones offline, and you'll be able to get access to those.
Judith, absolutely, and Nick as well, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this morning. And of course, if any further questions do come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. Judith, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you. So yes, thanks for listening, and thanks for showing your interest in this trust. We believe that it really is quite an inflection point for this trust. We've done the hard yards. We've gone through some significant changes in the portfolio, and some of them have been as we expected. Others have been harder, but those strategic mechanisms and almost like the private equity approach that we have to these kind of companies means that we can drive that intrinsic value coming through. And we really believe, and having again been through these cycles before, this is a really interesting time to be sitting with a decent amount of cash and being able to invest for the next phase of this trust life, and realise from the existing portfolio some very interesting returns, I think. over the next 6 to 12 months. Thank you.
Judith, that's great. And Nick as well, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Downing Strategic Microcap Investment Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.
Thank you.
Thank you.